bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the October 29th, 2024 podcast. It's our 850th episode of Tax Credit Tuesday. And given that we do on average one a week, that's a lot of years. In this episode, my guest Stephanie Naquin will share with us several hot topics in low-income housing tax credit property compliance. Stephanie is Novograc Director of Multifamily Property Compliance, and she's also a frequent guest on Tax Credit Tuesday. And more specifically, Stephanie is going to focus on 4 hot topic areas. First, the current state of the average income set aside, or AIT. We'll discuss specifically the varying comfort levels that owners and investors are gaining with respect to AIT. We'll also talk about the remaining challenges or barriers to using the average income set aside, as well as, more importantly, potential solutions that can make owners and investors more comfortable using the average income test. Our second hot topic will focus on the implementation of the Housing Opportunity Through Modernization Act, also known by the acronym HOTMA. We'll provide an overview of HOTMA, its effect on affordable housing compliance, and the interplay between HOTMA and the low-income housing tax credit. Third, we're going to discuss casualty losses at housing credit properties. This is a critical issue that affects affordable housing across the country, whether through hurricanes, wildfires, or other natural disasters. We'll discuss how tenants and property owners are impacted by casualties that occur in presidentially declared disaster areas. As many listeners know, the rules are different and more liberal in presidentially declared disaster areas than other areas. And fourth, our final topic is a good topic for the end of October. That's a end of year checklist for property owners. We'll cover important points such as identifying average income qualified groups of units, about correcting non-compliance, conducting physical inspections, and maintaining internal tax records. So with all of that, as you can see, we have a lot to cover today. So if you're ready, let's get started. Stephanie, welcome back to Tax Credit Tuesday.
Hi, Mike. Thanks for having me. And for episode 850, that's pretty cool.
Yes, it is. It's very cool. We're very proud to have reached 850 episodes and to keep going well beyond that. We're looking forward to 900 and then 950 and then 1,000. We'll have to see what we do in 3 years when we reach 1,000.
Well, I look forward to that.
So we've covered many topics over the past 70 years on the podcast. But before we dive into our hot topics of the day, please share a bit for our audience about the compliance services that you and your team offer to Novogradac clients.
Sure. So, I'm not an accountant. I sometimes play one on TV. I sometimes play an attorney on TV, but only in the capacity of understanding how those various things impact compliance. So myself and my team do a lot of different compliance-focused activities. That could be anything ranging from first-year investor tenant file audits to, consulting with HFAs about policies. And so the range and the breadth is quite extravagant, and it gives us a really cool kind of insight and understanding to the inner workings nationally in the various kind of compliance approaches. And so I'm happy to be here to nerd out on compliance once again.
Great. Thanks as well. And then you also do due diligence when properties are transferred, when new owners want to ensure compliance. There's a host
Yes.
of
I often feel like a used car salesman because people call me and they're like, well, can you do? I'm like, well, what do you need? We can do it. Like,
Yes.
pretty much is compliance, right? It's not a one size fits all solution. And so we are able to really kind of hone in and specialize those compliance services directly based on your needs. So there's no need too small or too big that my team can't tackle.
Great. Thank you for that. Now let's get started with our first topic of the day, the average income minimum set aside test, which, as I mentioned in the intro, we'll abbreviate as AIT, initialism AIT. So we've discussed the AIT and ensuing proposed and final regulations in previous episodes. And maybe I'll start with a quick recap for our audience that may not be familiar with AIT. AIT is an optional set aside through which an affordable housing project can qualify for low-income housing tax credit, low-income housing tax credits. And the concept of average income is just as it sounds. Under the general set aside test, there's the 40-60 or 20-50. Under the 40-60, 40% of the units have to average at least 60%, have to be at or below 60% of their immediate income. And under the 20-50, at least 20% have to be below 50% of their immediate income. And as our listeners know, that's just the general set aside test, but you only get credits on the portion of the units rented to low income families under either the 60% threshold or 50%. And as such, they end up, most properties are 100% affordable or 8% affordable, with usually a small portion are non-low income units. The average income test is a way of saying, okay, rather than have all the tenants be at or below 60% or 50%, the average has to be 60% of income or less. So you can have tenants at 80% income if you also select 40% income. So they average to 60% or below, which is a great way of getting a little bit more income diversity in a household and serve a broader range of tenants. By going to an 80% tenant, you can then have a lower income tenant, say a 40% income qualifying tenant. So that's the overall concept. That's the background on AIT. And I will put more information in our show notes on the average income test. In that, I'll include some previous podcast episodes and links to those and other content that provide a good overall foundation of AIT. But for purposes of today's podcast, I want to go into all the details of AIT. I wanted to focus more on the implementation of AIT. When it first came out, when it was enacted by Congress, we were all really excited about it. But then the excitement started to wane until we got guidance from the IRS. And then the initial guidance from the IRS caused interest to wane a little bit more. Maybe you could share, or I know you can, if you could share some of the historical challenges that property owners and managers face trying to adopt AIT.
Well, I gotta tell you, every October I might get a little twitchy because I have like past memories of average income, the evolution of average income, right? Because it was Halloween of October of 2020 that we got those. I mean, I'm not gonna say terrible proposed regulations, but no, it definitely, we all halted, stopped, I think, and they're a good 2 years, and then October of 2020. Oh my goodness. 3, right? No, 2. I'm like, what year
22.
is? I was talking about 2025 earlier, and so now my brain's like, what year am I in? So in October 2022, we got some final regs. And what we kind of received from those final regs is that Treasury heard us and heard the industry, and they really did a fantastic job in giving us a very workable tool. And so if we think about the challenges and the evolution of that, like no guidance, proposed guidance, final guidance, I think it was just the logistical and practical unfolding and understanding of how to comply in those different segments. And I think because average income introduces the idea of having to designate units in increments of 20 to 80% with 10%, increments, it really kind of caught us off guard on how this idea of designating a unit interplays with the sustaining of compliance under average income. I think we've kind of moved past that with those final regs. We all have an idea of what it means to designate a unit. And we were, with the final regulations, given some very favorable gifts in the sense of when we can change a unit's designations. But I do think there's still a little bit of push and pull in regards to changing designations that aren't kind of baked into that final regulation. So, kind of from a historical perspective of what it means to designate a unit of average income and how that impacts compliance, I think it's been a little bit challenging for us to navigate through. But I do think we're there from that perspective, and designating units is, I think that we're all on the same page. I haven't gotten a lot of about it. We do a lot of oversight with average income deals and designations of fluctuations of units. And, we've gotten really good processes down, kind of driven by each state on how clients work through that and navigate through that, and how we kind of provide support in maintaining that average income test and specifically the qualified groups of units. So that's the other thing I think has been like a little bit historically challenging is because what the term qualified groups of units really did for us is it kind of changed what the definition of low income meant under average income in the sense that not only is it to be income restricted and rent restricted and all the other things that you would normally apply under the traditional kind of, OG 20 at 50, 40 at 60 test, but now the unit actually has to be part of a larger group of units where the designations don't exceed a 60% average. So it's almost like an additional test that we have to fold in with what is a low income unit. It's been a little bit challenging, especially as we think through what the current barriers to entry are with average income.
So what are you seeing in terms of owners actually using AIT now?
For the first year or so, it's still a little bit slow. Investors were still, everyone still, is this real? Is anything going to change? They were, not really wanting to trust it. But I think in the last year, I've seen an uptick in it. And a lot of new kind of owners interested in average income. But I think also what I saw is the owners that were really excited about it before that proposed guidance came out have kind of re-entered the industry with that same zest and excitement. And so it's really folks that were wanting to use it before that have become more comfortable using it now. And I also noticed that we tend to see more average income deals in, well, first larger states that have a bigger population and different needs, but also have created policies that make sense around average income. Because really the contention with it soaring in all cases is some limitations that are contingent on state policies. But in general, I'm seeing an embracing of it. And I'm also seeing an embracing of it from the investor side as well. A little bit slower to embrace, still some belts and strings that are being put on those. But again, I think we'll see that loosen up a little bit as well.
So given that, does that mean that you're finding that investors are getting comfortable?
They're getting more comfortable, right? There's something that we have to remember in that final regulation. There was some temporary components of those regulations relating to reporting requirements. And some of those temporary reporting requirements had to do with how we were reporting the qualified groups of units. So annually, I have to report to the state my qualified groups of units for my 40%, so my minimum set aside, but also the qualified groups of units. They call it for the applicable fractions. It's kind of a weird way to say just the designations of all the units. And so inside the average income kind of rules, we have a very clear path to mitigating any impact noncompliance has to our credit delivery inside the tax year. But when the taxable year closes, part of the temporary regulations that says, hey, if you identify or discover something after the close of a taxable year that would otherwise impact what you reported to the state in any given year for your qualified groups of units, up to the state's discretion, you have 180 days after the date of discovery to kind of amend or correct that reporting. It's the state's discretion, I think, that still opens up a perceived risk and where investors are still feeling a little bit uncomfortable and complete buy-in. But I'm seeing some really wonderful workarounds. And so I'm not seeing any investor going, nope, we're just not going to do this until this thing was changed, but rather just requiring a couple of extra things in average income deals until such time that we get those final regs. I do want to remind everyone that this is a temporary part of the reg, and temporary regulations generally kind of live for a 3-year period before action is required to be taken. So if we think about that 2 years ago, we got these temporary regs, we are now in the 3rd year. So what I'm hoping is within the next year, we will see something final from Treasury as it relates to these reporting requirements.
And just so the audience is aware of the sensitivity here is the issue with average income test is if you ended up having you ended up being say 61% because one unit was 70% instead of 60, then you theoretically would fail the set aside test. And as such, you'd have recapture on the entire.
We're back on that cliff.
You're on the cliff. And the whole purpose of the average income was to not have a cliff effect. And under the 40/60 or 20/50, if one unit was out, then you just lose kind of the pro rata.
Mm-hmm.
So that's the reason why there was such a sensitivity to these issues. And you mentioned there's some sort of potential solutions. Do you want to share what some of them are, as well as what
Sure.
might be available in the longer term?
So, primarily what I'm seeing is that investors are really wanting two things. First, they're wanting to see what the state agency policy is as it relates to this particular waiver provision. If the state agency has a very kind of clear policy that is reasonable and allows the owner to, amend or perfect that qualified group of unit at any time, well, of course, within 100 days of discovery, they tend to be less concerned about their ability to stay on the cliff. But in absence of state policy, or in state policy that may be too restrictive, we're continuing to see the requirement of that buffer, right? So if 60% is that federal cap over which you can't exceed an average, maybe driving down your average something like 58% so that you're more protected from any kind of cliff issue.
Right. Basically have a unit, have a certain number of units that are provide a cushion. And
Yeah.
one
I mean, the
thing,
thing is like a little bit to the extent that, it's the lower set aside units that have the most impact on your project's average. And because it's those lower designations that somehow that creates a larger opportunity for impact of the average when units go out of compliance.
right.
And so that like rationale is really kind of based in that.
And I'm curious what you're sort of seeing out there, because when the average income test first was enacted, there was some discussion that every property would elect the test, even if they were going to rent everyone, say below 60, even and rent everyone below 60, that you would elect the average income. So if you ended up having an issue, while you thought all the units were below 60, if one ended up being above, the average would still be below 60.
Right.
It was actually safer just to elect average income somewhat universally. Are you seeing anyone actually doing that?
Yeah, I mean, I still see that same kind of mentality from an approach perspective, but I do a little bit caution against that because, you know, before we kind of thought we had pure flexibility in the movement of designations.
Right.
And now while we have the ability to redesignate in certain circumstances, and we can always reduce someone's designation, and if there's not some sort of state policy that allows us to recognize a higher designation, I'm not sure that gives us the same coverage, right, as it would have otherwise given us. And so if there's a state policy that says, hey, like if someone wasn't income eligible at 60% and you're still okay with the project average at 80%, if you throw that in there, fine, let's do that. That works. But it's just not on pure face value something that is allowed for under that final reg.
Got it. Thank you for that. Let's move on to our next topic,
Okay.
and that's the implementation of the Housing Opportunity Through Modernization Act. And as I mentioned, that goes by the acronym HOTMA.
It's not a hot mess. hot.
It is not. Please provide a brief overview as to what HOTMA is, at least as it affects property compliance, and how it affects, as I mentioned, how it affects affordable housing compliance.
Right. So first, I want to remind everyone the HOTMA was enacted in 2016. So like it's about to be 10 years and like a couple of years that this has been in play. So it's taken a long time for us even to get here to have these conversations. And effectively what it did is it made sweeping changes to the U.S. Housing Act of 1937, right? So that's all things really under HUD. And that's really found in 24 CFR Part 5. So any of you guys have been doing this for a minute, you throw around the Part 5 definition, and that's really kind of what we're talking about. Now, HOTMA has a lot of different sections, guys, and we're just really focusing on 3 sections that we're having trouble figuring out how to implement. So section 103, it's not even in our wheelhouse because that has to do with over income tenants and like public housing. And so that's not something that we're going to deal with. So then we have sections 102 and 104. 104 has to do with like asset limitations. And so that we're not really going to get into that. So really it's just about section 102. And that created changes to what we consider income and assets, or how do we calculate income under these various programs. And I've been doing this for a hot minute. HOTMA, get that? No. And it really is the largest change in how we approach determining income eligibility under any affordable housing programs, because most affordable housing programs adopt the Part 5 definition. Now, the reason why we need to be kind of sensitive to what it means to be in effect and how we implement it with the compliance by date is that because HOTMA impacts everything related under the U.S. Housing Act of 1937, which is like all things HUD, there's different branches and there's different divisions of HUD, right? So we have your PIH, you have your multifamily housing, and you have your community planning and development, which is CPD. So that's like Home and National Housing Trust Fund. And each one of these kind of branches of HUD have to figure out how they're going to implement these provisions of HOTMA for their particular programs. And so, we got one implementation notice for PIH and multifamily housing. We got another implementation notice for CPD. And of course, we received extensions on the compliance by deadline for these various programs.
So technically HOTMA went into effect January 1 of this year, January 1, 2024. As you noted, the compliance by date continues to move. So where do we stand with respect to the compliance deadline?
Well, we got to think about each one of those kind of branches of HUD, and then we got to talk about how this interplays with the LIHTC program, right? So for PIH and multifamily housing, we in September were informed that their deadline by which to comply is going to be, it's moved from January 1st of 2025 to July 1st of 2025. Now, for CPD, we haven't received any sort of extension or any kind of information from them since December of 2023 when they issued their implementation notice and had a compliance by deadline of January 1st of 2025. So as it stands right now, for your Home and National Housing Trust programs, it appears as though HOTMA is in play for certifications January 1st of 2025. But for those other programs under PIH or multifamily housing, it's not in play until for certification starting July 1st of 2025. And that really has to do fundamentally with the interactions of the changes on those various programs and the software that's used or is not even used, but necessary to implement these changes for the PIH programs and the multifamily housing programs like TRACS that aren't necessary for programs like Home. They're not necessary for programs like the LIHTC program. And so it gives us a little bit more flexibility, I think, for the LIHTC program and how we're operating. And I know everyone's thinking, why does she keep talking about the LIHTC program when she keeps talking that this is a HUD issue?
Yeah, that was what my next question was going to be.
I didn't rip that Band-Aid off, right? Well, guys, when Congress created the LIHTC program back in 1986, they said we're going to calculate income in a manner consistent with the U.S. Housing Act of 1937. So because we calculate income in a manner consistent with how HOTMA has changed that act, then we, by extension, are having to change how we assess and calculate income for the LIHTC program.
Great. So kind of in essence, the compliance rules for tenants, since we looked at HUD and HUD is changing their rules, those rules are changing. And we had a prior podcast where we talked about some of the notable changes. Put a link to the show notes to that prior podcast. I know you've written about it as well. Is there anything else you wanted to say about HOTMA and how the listeners or viewers should be getting ready for HOTMA compliance?
Yeah, there were a handful of states that were, hey, January 1st, 2024, that's when that says it was effective. That's when it's effective for us. And so there were several states that through this entire year have been completing income certifications under the LIHTC program using HOTMA changes. So where states weren't requiring HOTMA changes, a lot of states were allowing for it. So giving the owners the opportunity, not penalizing them for, taking this opportunity this year to learn. But most states were moving for a compliance by deadline of January 1st of 2025. I'm not hearing from a lot of states that because of the extension to July 1st of 2025 for the PIH and multifamily programs under HUD, that they too are choosing to expand it for the LIHTC program. They've taken a lot of time to kind of gear up and get it going. And again, those same barriers to entry that those HUD programs have for fully implementing HOTMA aren't the same for us. There was a lot of states that were on hold until NCSHA came out with their recommended forms, and they're kind of the national council that contains those state national recommended forms. And we were lucky enough as a firm to be able to collaborate on what those forms look like. So now that they're out, part of that collaboration was working with software providers to make sure they could seamlessly integrate into existing software so that we wouldn't have the same barriers to entry for the LIHTC program as folks are experiencing with the HUD side. But like my kind of feedback is like, HOTMA is great, guys. Like it's a change. I get it. Compliance folks, we don't like change most of the time. But the farther we put off making the change, the harder it's going to be to acclimate to that change. And so, but before it comes over, let's take advantage of the flexibility we've been given by our state agencies in regards to when we need to kind of go live with this.
One of the interesting effects of the different state agency interpretations is, as a technical matter, the tenant income is being calculated differently
Yes.
across different jurisdictions. What has the IRS said informally about that, those differences?
Yeah. I mean, and you're right. Everything thus far that has come from, the IRS or Treasury has been it's been informal. Part of the comment that the Novogradac LIHTC working group made to the priority guidance plan is, maybe some changes to language to get everyone purely clear that this does apply. But in my informal discussions with various folks, that they're almost, we don't really understand why we need to publish guidance because in the -5 reg, it says you calculate in a manner consistent with the U.S. Housing Act of 1937. That change, therefore, what you should be doing changes as well. And then I guess the other thing too, if we think through like our experience with average income and that whole back and forth with good guidance, bad guidance, trying to get it right. I'm almost a little bit weary and even needing that level of clarification in that sort of informal space. And I also just don't think we need it. But informally, they're kind of like, oh, we don't get why you guys need it, but I guess we'll do something.
Be careful what you ask for, as they
There you
say.
go. Oh, true.
So turning to our third topic, sadly, has to do with casualty losses. The recent destruction caused by Hurricanes Milton and Helene underscores the importance of safe housing for all. And obviously, the loss of the tax code plays a large role in housing many vulnerable households. You and I both know also that there are separate rules in terms of the impact of a casualty on a taxpayer property, depending on whether or not it's in a presidentially declared disaster area or not. And I won't go into all the history of the difference. In the Novogradac Low-Income Housing Taxpayer Working Group has tried to get the IRS and Treasury to expand the liberal aspects of treatment of casualty losses in a presidentially declared disaster area to all casualties.
Mm-hmm.
And ultimately, it looks like it takes legislation to do that. But if you could please take a moment to share for our audience the differences, the different ways a casualty affects a LIHTC property in a presidentially declared disaster area or outside of it. And you just do a high flyover, because this is a very complicated and intricate question that affects property owners and tenants in a variety of ways. But if you could just share what some of the typical issues that you face working with clients, that would be really helpful.
Sure. So like casualty loss in and of itself is something that is like unexpected, sudden, something that couldn't be avoided. And so we have things like fires that occur or a flood in our buildings that occur. Those are unexpected, unavoidable, unusual types of events. And if those types of events are a result of a presidentially declared disaster, how we treat that and what those rules are just a little bit different. So I do want to like highlight that they are different, although they're both based on this idea that what happened to the buildings was unexpected and sudden and unusual. But they have a little bit different reasonable restoration periods. And so the time in which that you have to restore those buildings is a little bit different. Something to be in a presidentially declared disaster area really has to have two conditions met. First, it has to be declared by the president, and you can go to the FEMA website to figure out if there's a presidentially declared declaration, rather. And also, FEMA has designated that area as eligible for individual and or public assistance. And so it's very important that those two provisions be identified as met and not just assume that just because your county was in Florida that it met those particular requirements for this purpose. So the FEMA website is really helpful. It'll go in, it will break out the various counties that were eligible for individual assistance, public assistance, or both, or none. And there could be overlap in those, or there couldn't be, and it's just a presidentially declared area. So it's really important that you're first identifying that you're in an actual presidentially declared area and not assuming that just because you're part of a state that experienced disaster, that all things kind of extend to you.
So what should, maybe you could break out the impact, the differences between a general, I'll call it a general casualty loss, one outside of a presidentially declared disaster area versus a casualty loss inside a presidentially declared disaster area that meets both requirements. And those requirements became really intense around COVID.
Right.
Lots of presidentially declared the whole country, but then it had to do with what did that declaration mean. But let's not get into all of that. If you just talk about, once again, at a high level, in a disaster area, not.
In a disaster area, your reasonable restoration period, so the period by which you need to get those buildings back online, is 25 months from the close of the month in which the president declared the event as a disaster. Whereas with normal casualty loss, you have 2 years after the year in which the event occurred to restore. And those reasonable restoration periods are very important because if you don't take the right action to restore your buildings within that reasonable restoration period, all of the normal impacts of a unit not being suitable for occupancy kind of fall back into play.
Just to make clear, let me just insert there. That's your period of time you have to restore to avoid recapture of
That's right.
previously claimed credits.
That's right.
So that's recapture previously claimed credits. Now talk about the ability to continue to claim credits.
Right. So in a normal casualty loss, or not in a presidentially declared, I am not able to claim credits for the years in which my units are not suitable for occupancy. And so to kind of to your point, Mike, like we've been wanting to align regular casualty loss with presidentially declared, but because of this next state for presidentially declared casualty loss, I actually get to, not only am I not subject to recapture of already claimed credits, but I also continue to claim credits based on what my building's qualified basis was as of the close of the year and the year in which before the event occurred. And so that's kind of the nexus or the real key difference from a credit delivery perspective is that one, you continue to claim credits in the years in which your buildings are offline, and one, you don't get to continue to claim credits in the years in which your buildings are offline.
Yes. And then when you just put a finer point on it in terms of what it means under the general casualty loss rule, whether that your building's online or not is determined at the end of the year.
Always 12/31. Yeah. At 12/31.
You had a fire in January. You have 11 months to get the building back online.
Mm-hmm.
A fire in December. You have less than 31 days.
That's right.
The building back online to continue to claim the credits under the general casualty loss that occurs outside of a presidentially declared disaster area.
Mm-hmm.
There's a number of other issues around 10% tests, around first year lease up and all the rest. So we're not going to go into all of those.
But that is important to touch on because you don't have those same kind of options under regular like casualty loss. It's only available under presidentially declared. And so depending on where you are, you have like certain carve outs and provisions that you can take advantage of, depending like if you're coming in with a 10% test, if you're placing in service, if you're in year one. And so I think that's a real interesting kind of interplay and dynamic of what it means to be in a presidentially declared area and a disaster area. And a reminder to folks that you must determine that you are actually in one of these areas, because if you apply the wrong rules, that's going to be a big problem.
So we don't have the time on this podcast to go to all of those different ones.
Mm-hmm.
I did want you to just touch briefly on the resident side.
Yes.
On the recapture side, continue to claim credits. We haven't discussed the more intricate parts of place and service dates and things of that nature, but let's focus on the tenants. And, if a LIHTC property is suffering casualty loss, then in all likelihood, there's going to be some temporarily displaced residents who need housing.
Right.
So how has the IRS addressed that with respect to disasters in presidentially declared disaster areas?
So they do have a component of emergency housing relief for displaced individuals. And so in order for someone to satisfy this requirement, they do have to attest that their principal resident was in a designated major disaster area and that they were displaced because of the disaster. And if that's so, if an owner of a LIHTC project has vacant units, they can actually allow those displaced individuals to live in those LIHTC units without having to undergo the full income certification component that we would otherwise have to do for a LIHTC eligible tenant. It's a temporary housing period, so it's limited to a 12-month period. At the end of that 12 months, the tenant does have to be identified and verified as income eligible for the LIHTC program. On day 61, if they don't get that taken care of, like if there's some issue in which they're not eligible, they have a 60-day period to cure that. And on day 61, all the regular things related to noncompliance kick back in. But I think the key here is that if you have vacant units, this gives you the opportunity to really serve the population that your project was built for. And it allows you to kind of cut through a little bit of the red tape in the sense that a lot of these folks that are displaced don't have the records that they would normally otherwise have if they were applying as just an applicant at your, regularly scheduled LIHTC deal.
Thank you for that. And I just would build on that by saying that, a owner, if they do qualify the income of the tenant, then that tenant will be good indefinitely.
Yeah, good point.
And if they don't go through that, then the tenant is at 12 months.
Yeah.
They're good for 12 months, but then they may not be.
Right.
And you have to deal with occupancy, eviction, and other sorts of issues as a property owner, or run the risk of having a non-qualified and ineligible tenant in that unit.
Really good way to put it. It's an option that we have. You're not you still can certify them fully under the LIHTC program. If you do, they're just a regular LIHTC tenant and you operate just like you would any other normal tenancy. It's just that if you do house a displaced individual and you're doing it so under this particular revenue procedure, just know that you will have to take some action. And the other thing is I want folks to know, like, this isn't some sort of like back channel to correct noncompliance. So, for example, if I have a unit that has some sort of noncompliance issue and it happened to be vacant and I fill it with a displaced tenant, it doesn't correct the noncompliance. That unit would take back on the characterization it had before the displaced individual lived in the unit. And so I want to make sure I'm dispelling, like, it's very contained in the sense of it's limited to this 12 months. During that 12 months, you get to operate as though it's a LIHTC tenant. After that 12 months, to your point, Mike, there's a lot of things that you do have to do. So you got to be on the lookout for that.
So let's move on to our fourth topic, in the final topic for the day. We'll have to have you back soon because there's always more hot topics in property compliance.
And always, yep.
And that has to do with what property owners should be mindful of as they are reviewing their end-of-year compliance checklists. Because there's certainly a lot of matters that you want to correct by the end of the year. So this is always a time we're encouraging clients to run through this end of year compliance checklist. Share with the audience some of the considerations they should keep in mind, items that should be sure to be on their checklist that they run through before the end of the year.
It's such the perfect time to be having this conversation, right? This is going to be airing at the end of October. So it gives us a nice 2 months to kind of think through what these things are and how do they impact my buildings. So to your earlier point, Mike, 12/31, very important date, right? Every year, that's kind of almost in a vacuum. If we're not in the first year of the compliance period, when we're looking to make sure, do I have enough units to include in my building's applicable fraction so I'm not having a reduction in my qualified basis that would trigger some sort of impact to my credit delivery? And so taking a little bit of time now to add that extra layer of due diligence in, anything that is identified and corrected in the same taxable year is not going to have that credit impact on 12/31. So that goes not only for maybe unknown things and doing a little bit of due diligence, maybe sampling your tenant files, making sure that things that you thought were getting done, but it also extends to any sorts of known events of noncompliance that you may be trying to work through. I always say try to work through these things as diligently as possible. But as the end of the year approaches, you really should be focusing and working almost more diligently, if that's a way to phrase it, on correcting those issues. And I think it particularly becomes an interesting conversation when the state agency goes out and does a tenant file or a physical inspection, in the last quarter of the year, and maybe you don't receive the correspondence until later in the year, and 12/31, you're still in a correction period with the state agency, or you haven't been made aware yet by the state agency of the issue. Remember, guys, the state agency's role is to allocate and then monitor to make sure that you're complying with the provisions of your regulatory agreement, and then to observe, identify and notify the IRS of any issues they observe. That is different than what our role is as operators. They kind of function, sometimes they function in tandem, but a lot of times they function individually. So, said differently, just because you're in a correction period, if the unit is out of compliance on 12/31, that just means your response to the state agency isn't due yet. That doesn't mean that it doesn't impact what happened on 12/31 for the purposes of your qualified basis. So keep that in mind. I had this discussion all the time in January of a year. But I was in a correction period, Stephanie. I didn't know, or it wasn't due to the state yet. I'm like, well, those are different processes and different rules. So really being aware of that. I know we talked a little bit about casualty loss, but I feel like if we could write into the code, like no Christmas trees are allowed at any property, like in December, that might help us a little. Because it's always a fire in December, and it always happens towards the end of the year. But all joking aside, if you have casualty loss and it's known, taking whatever steps possible to get that resolved by 12/31 is really going to be very important for your credit delivery in that year. And even if you're not able to resolve all of the events surrounding casualty loss, whatever you can get taken care of. A lot of times people think it's like an all or nothing situation, and it's really not. It's going to always fall back on your applicable fraction. So it's looking at units. So how many units can they get online? How many units can they get out of this casualty loss space by 12/31? And if that is incrementally increased in a year, that's much better than it hitting kind of all at once.
Excellent. Thank you for that list of items to be sure to be included in your compliance checklist. I would encourage listeners to also reach out to Stephanie for a more exhaustive list. Go ahead. One more.
Sure. Okay.
Sure.
The other thing is that I often talk about is it's not a surprise, guys, when the state agency is going to come and visit you. It is on a 3-year cycle at minimum. And so if you had a tenant file review or a physical inspection in fall of 2021, guess what, guys? You're going to have it in fall of 2024. And so I would suggest that's an even more of an opportunity to get ahead of those kind of weird year-end quirks as it relates to timing with those state agency reviews.
Excellent. Thank you for that. And thank you for sharing all your various insights, Stephanie. And I appreciate you joining me on the podcast today. I know our audience does. We will include your contact information in the show notes so they can follow up and get additional detail on a large number of items we discussed here today, and also items that we did discover, but pressing compliance questions they have.
Definitely.
Insights and tips really valuable. To my audience, I do invite you to subscribe to Tax Credit Tuesday on our website or through Apple Podcasts, Spotify, and YouTube. We have close to 4,000 YouTube subscribers, so we're proud of that. And if there's another podcast platform you think we should be on, please let us know by emailing us at cpas@novoco.com. And I also encourage you to share the podcast with your colleagues and others in the community development community that would find the podcast of use. And as you know from the beginning, there are 850 episodes available for download. So there's all sorts of topics covered. So it's a great way to get some expand your knowledge in a variety of areas. So I wanted to turn now to our up mic section. And this is a pretty enjoyable segment where we get to acknowledge industry colleagues with shout outs. So Stephanie,
Yeah.
What is your industry shout out for the week?
So my industry shout out is actually the director of multifamily compliance at the Texas Allocated Agency. Her name is Wendy Quackenbush. She has been with the agency for a very long time. And in her capacity, especially over the last couple of years, she's just really stepped up and run that division in a really respectable way. She also serves on the HCCP Board of Governors for NAHB. And so she's really plugged in on the national level and was really the person at the Texas allocating agency that said, no, guys, we're going live on HOTMA on 1/1/2024. And they did a considerable amount of training in the fall of 2023 with their partners. And they continued that training through 2024 through various webinars, roundtables, just kind of industry chats, which has been really refreshing because it gave my team like an ability to look at thousands of HOTMA files, but also it gave the entire state of Texas a level of comfortability that we got this. And I think it's because of that experience that I'm so bought into, we can do this. It's just a change. As long as compliance is always like, we got to understand the black and white and we'll figure out how to do it. Just give us the rules. We'll figure out how to do it. Let's stop with this kind of kicking the can down the road. And so to that, shout out to Wendy Quackenbush and thank you for everything that you do in this industry.
Great. Thank you, Stephanie. And I'll echo your shout out to Wendy Quackenbush. Thanks for all your leadership you're providing in the great state of Texas and the nation as a whole. And thank you, Stephanie, for joining us on the podcast. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.